Hello and welcome to Options in Plain English. Today we're going to talk about types of volatility. A lot of traders get confused and overwhelmed by the different types and different volatility measures that they can find on their platforms. What we're going to do here is we're going to take a look at all these types of volatility and we're going to see what they measure and which ones are important and which ones we should maybe not pay too much attention to. First one we're going to take a look at is historical volatility. Historical volatility measures how much the stock moved in the past and is calculated from stock prices. So if you take a look here, we're looking at the price chart of Apple, AAPL, and this is pretty much 1 year's worth of data. These are the prices. They're changing as time passes. And if we go to a certain point, say for example here, and we take a look at at a period in the past, say for example 20 days, and we measure the fluctuations that Apple had in its price, then we can get a measure of the variance, and the square root of variance is going to give you the implied volatility. So historical volatility is a measure of volatility of the stock that happened in the past. It's taken from stock prices. We don't use options at all. And for option traders, it could be a good indicator, but it's definitely not very important. So I would say it's good to know, but it's not critical. If at some point you don't have access to information about historical volatility, you can carry on. It's not very important. Historical is, like I said, in the past, so it doesn't tell us anything about the future. Thinkorswim includes a study that allows you to plot the value of the historical volatility of a stock, and the only parameter that you need is how many days back you wanna have in the calculation. In this case, down here in the bottom in purple, we have historical volatility, and I'm calculating it for 22 days, which is roughly 22 trading days, about a month. So this would be a how the historical volatility has changed over time. As you can see, when the stock price started getting volatile, after a certain time, because you need these values to start contributing to this calculated measure, the chart is going to start showing it. Again, not critical to have, good to know, but not very important. The second one is going to be realized volatility. Realized volatility is something that's very similar to historical volatility. It's calculated from stock prices, from the fluctuations in stock price. You get the variance, and then you get the implied volatility. It's a measure of fluctuations in stock price, no options at all. The reason why there's two terms for historical and then realized volatility is because historical volatility usually refers to things that happened in the past without context, and realized volatility is usually compared to the implied volatility for that period. So for example, if we're on this day and the implied volatility tells you that the stock's going to move 20%, for example, in a period of about 2 months, which is what we have here. This is what the implied volatility is predicting. Remember, implied volatility is taken from options as opposed to historical and realized, which is taken from stock prices. So for that period, you measure how much it actually moved. So what the implied volatility was predicting versus what it actually moved. So what it actually moved is usually referred to as realized volatility because it's the volatility that was actually realized in the market. So it's a way to compare the actual move versus what the implied volatility was predicting. And that's what realized volatility is. Is it important? It's not very important. Usually, only when you are thinking or analyzing whether an implied volatility for a certain stock or for the options of a certain stock are too high, then you would think about, okay, the realized volatility is going to be less than what the implied volatility is suggesting, or vice versa. So realized volatility, not very important. The next volatility that we're going to take a look at is IVstrike. This is the first one that we're going to analyze with respect to implied volatilities, IVstrike. So what that means is, and maybe not every platform is going to be referring to it as IVstrike, but the concept is important to understand. So IVstrike is the IV from every option, so from every type, expiration, and also strike, using the option prices and applying a pricing model. So there are many IVstrikes for every underlying. So if you take a look at the trading page for Apple, you can see here we've opened up already the May expiration and the June expiration. May with 14 days to go, June with 49 days to go. So different expiration, different types. These are puts, these are calls. And every option here, every strike price, if there is a strike price, if there is an option and it has a price, it has an implied volatility, because you just apply the option pricing model and you can extract the implied volatility from there. So in this case, for example, I've pulled up the column for implied volatility. So these are the different implied volatilities per strike. So this one, the 290, for example, in May, the May expiration, this one in particular, the 290 has an implied volatility of 37, and then the 285 has 39, and then the 280 has 40. That's the put. The call has an implied volatility of 35, and then 34, and then the 290, which is close to the at the money, 33, and then a different month has a different month has a whole group of different options, and those options have different implied volatilities from each other and from the previous expiration that we were looking at. So as you can see, IVstrike is many implied volatilities per underlying. So Apple has as many implied volatilities as options there are. So that's what we would call IVstrike. Now, is it important? I would say yes, because that is the closest you can get to an actual value of implied volatility that is not theoretical. It's actual value of implied volatility, because it's being traded in real time right now. If traders start bidding up a certain strike and or the options of a certain underlying, that would affect the implied volatility for that underlying, and that would mean that the overall implied volatility value is going to be bid up. And this is not a theoretical value or something that happened in the past. This is being calculated in real time. So IVstrike, every contract, every option contract of every type, put or call, expiration, like these two, May and June, and also every strike has different implied volatilities. The next one that we're going to look at would be IV per expiration. So something similar. We were talking about IVstrike. There's many implied volatilities here for the puts, here for the calls, for different expirations. So usually what trading platforms or brokers would do is calculate a single implied volatility for that expiration, so that you can compare different expirations and see how IV changes over time and over the different expirations. So for example, if you take a look here and I collapse all the expirations here, for every expiration here, we have a value of implied volatility. Now, how was this value calculated? You can see here 39, 38, 39, 38, etc. So you can tell that it's very close to the same value for all the different expirations, but it's not exactly the same. So how is this value calculated? So to the best of my knowledge, what they do is they take all of these options for the same expiration and using all of them, but giving more weight to the ones that are at the money and closer to at the money, they obtain a single implied volatility number for that expiration. Is this number important? It is important because you can tell by looking at this number, you can tell whether the market expects something to happen very soon, and a binary event could be priced into a certain expiration but not the others. The next volatility we're going to take a look at is IVX. Some people call it IVX. Some people refer to it as just implied volatility. This is the one single value for the implied volatility for a certain underlying at a certain point in time. So right now, Apple has a certain implied volatility. How is that calculated? Well, it uses pretty much all of the different options for that underlying. It weighs them in a certain way. The ones that are closer to at the money are given more weight. And I understand also that the weight given to front expirations is higher than the one given to back expirations. So the ones that are closer to expirations are given more weight than the ones that are very far out in time. And this is pretty much a proprietary formula. It's not shared with everybody, but it uses all the different options for that underlying. And the important thing is, this is the one value where you can be referring to, for example, in this case, Apple having a certain implied volatility, one single number. So it's the number that is reported. For example, if you take a look here at Thinkorswim and you go to option statistics, you can see it has a current IV value of implied volatility of 3872. Now, where is this 3872? Well, it's a blend of all these values. And that's how you get one single implied volatility value. It doesn't matter whether the calculation is accurate or whether the weight that is given to at the money, out of the money, etc. is good. The important thing is that if you apply the same formula and apply the same algorithm to obtain it, and then you analyze it over time, you can start to see when its relative value is being too high or too low. So whether the implied volatility calculated by Thinkorswim differs from the one calculated by Interactive Brokers or E-Trade or any other platform, whether they're different, it's not very important, because as long as you compare your Thinkorswim implied volatility with your same implied volatility from Thinkorswim later, as long as you're using the same algorithm, you're going to see whether implied volatility went up or down. And that's going to be a good gauge that's going to be used for structuring your trades. Also, IVX or IV is what you show. For example, here I've plotted on Thinkorswim. You can plot the implied volatility over time, so you can see how it's been changing. This is not a historical value. This is not what happened. This is what the options had in them based on pricing. This is the IV. Now, a single IV does not exist for an underlying. There's only IVstrikes, but if you combine them all and then you get a blend and you get a value, that's what you get when you look at the IV value. And this is what's being plotted here. You can see how it's been changing over time. You can very easily tell that the options here were elevated. There was a lot of fear. There was a lot of instability. And that's what looking at this value allows you to get. Now, is it important? It's extremely important. I would say probably the most important value of implied volatility. Now, remember, it's not necessarily accurate. There is no single IV that you can get somewhere, or a single IV that you can buy or sell and trade, but it's the one number that tells you whether the implied volatility, either comparing it to itself over time or comparing it to different companies in the same sector, for example, or whether different sectors, if you're talking about ETFs, whether the pharmaceutical sector is being, it has the pharmaceutical sector contain a lot of companies with a high implied volatility compared to, for example, the mining sector or anything or any other sector. If you look at their ETFs and get the implied volatility, you're going to be comparing apples to apples. So yes, this volatility is very important. Implied volatility, IVX. I don't know if a lot of traders call it IVX, but if you listen to someone say Apple has a volatility, for example, right now Apple has a volatility of 38.7, as we were saying. That 38.7 is IV or IVX, a single value of implied volatility for that underlying. Now we're going to start looking at relative values of implied volatility. And the next one coming up is IVrank. Now, IVrank takes the implied volatility value that we mentioned before, the IVX or the IV. It analyzes it over time, and it tells you over time, if we were to make a scale from 0 to 100, where is the IV value in that scale? So it's going to be a number from 0 to 100. And we're going to be taking a look at a certain look back period. So the actual definition is a relative measure of where the underlying's IV is today compared to where it has been in a certain look back period, which is typically 1 year, scaled from 0 to 100. So IVR is always going to be from 0 to 100. And what you do is you take 1 year back. So for example, we have 1 year. You see how the absolute highest value you can get here, and then the lowest value is here, and then that's going to be your 0 to 100 scale. And you just need to take a look at where it is today and see where it is relative to that scale. So for example, yes, Apple has today an implied volatility of 38.68. Right now it's changing because we're during market hours. 38.68. So 38.68 has a relative measure when compared to the highest and lowest value over the last year of 23. So I have a little script that actually calculates the IVR. So if I tell you Apple has an implied volatility of 38, that might not tell you much because you don't know how much Apple usually moves. But if I tell you the IVR is 23, it means, okay, so there's in a scale from 0 to 100 over the last year, we are in the 20 at the 23 level. Okay? And that's what IVR tells you. Is it important? It's very important. A lot of people use that to trade. So as to get a good understanding and a good sense of where the IV is compared to past values of IV. So for example, if many traders, what they do is, for example, they would only sell options when the IVR is over, let's say 40. Which means they're going to sell options only when the IV is in this area. So when the IV is elevated. Now, there is one significant drawback to to this relative value to the IVR. And this drawback, this flaw, is that if there's a single spike, so for example here, there is this little period where there was a lot of volatility, well, it's going to be very hard for the implied volatility to get back to this level, and all of them are going to be relatively undervalued. So they're going to be understated by using IVR. So spikes up and also spikes down are going to be, in a way, skewing the number, because now the absolute scale, the 0 to 100 scale, is going to be usually larger than it would have been otherwise, and single specific instances are going to skew the number. That's the main flaw of IVR. The advantage is it gives you a relative value of where IV is, and it's readily available. Pretty much every platform shows you the IVR. I have a little script that puts it right here, and I also use the color to signify whether it's a high value or a low value. Right now, if you see a red, it means it's a low value. Even though if you compare, right now we are at the 20 on the 23 rank, IVR equals 23, but even though it's low, there's been many instances where it's been lower. And this is where our next relative volatility measure comes in. IV percentile. IV percentile is also a relative measure of IV. So remember, IVX. And it's a relative measure of where the underlying IV is today, considering how many instances in the past were higher versus how many were lower in a certain look-back period, which is typically 1 year, and scaled from 0 to 100. So IV percentile is calculated a little bit differently and addresses the problem of single instances that skew the number for IVR. IV percentile looks at where the IV is, so for example here, and then it goes back 1 year and sees, okay, I'm going to count how many instances out of the last year were higher than where I am now and how many were lower than where I am now. If all of them were lower, then I'm at the top and I would get a 100. So it's scaled from 0 to 100, similarly to how IVR is scaled. But the difference is that a single spike in this value is not going to skew the number, because that's going to count as 1. If it's a sustained period with a lot of high values, then yes, it's going to modify the number because it should. So IV percentile, in my opinion, is a little bit a more realistic way to look at the relative value of IV compared to itself. So in this case, for example, we're at 3865. We look back 1 year and we count how many instances. It doesn't matter by how much. It doesn't matter the magnitude. It's just how many were lower, how many were higher. And out of those, we scale them to 100, and the percentage is going to tell you where you are. So in this case, 3865 represents, for Apple, an IV percentile of 81%. See how different it is from the IVR. The IVR was 23, but the IV percentile is 81, which means that 81% of past instances, if you go back 1 year, were lower than where I am now, and only in this case it's 81. So 81% of all instances in the past going back 1 year were lower than where I am today, and 19% were higher. So it's a good representation, because even though the IVR, so taken from the scale from 0 to 100, is 23 because it's here and not here or here, if you take a look at the past, 81% of the time they were lower than where I am now. That's why I have an IV percentile of 81. So in my opinion, it's a more realistic, a more accurate representation of where your IV is relative when you compare it relative to itself over time. In this case, looking at 1 year in the past. The last one that we're going to look at now is, and I'm including it just because it's very important, but it's rather than a type of volatility, is an actual measure of volatility, which is VIX, V-I-X. Everybody refers to the VIX. The VIX is an index, so it's a widely followed index representing the implied volatility, so the IVX, for the S&P 500 index, so the SPX, over the next 30 days, expressed in annualized form. So VIX is a number that you can get. This is an index, SIBO Market Volatility Index. Right now it's 3848. And as you can see here, it measures the volatility in SPX. So this is SPX, okay, the S&P 500 index. And if you go to the options for SPX, and you apply a certain formula, which is a proprietary formula, but basically it's something similar. It looks at the next 30 days and see and it takes a look at the most important options. So which are the options that are almost at the money and very close to at the money, and then you weigh them by how close to at the money they are, and also you weigh them by how close in time they are to where you are today, and then you get the implied volatility same way or a very similar way as when compared to how you would calculate it for a certain stock or for a certain ETF. But when it's applied to the SPX options, you get a value known as the VIX. And this index is a quick at a glance look at how the market overall, especially we're talking about the North American US market. So it's a good at a glance, again, quick look at how volatile the market is by looking at the S&P 500. This is an index. You cannot trade it, you cannot buy it or sell it, but you have options on the actual index, and those options, instead, because there is no deliverable, so when you get assigned or if you want to exercise your options, you can't. Those are, first of all, European type option or European style, meaning it's only at expiration, and instead of settling with stock, meaning you get stock or short stock, what you do is you get their cash settled. You get the cash that is the difference between where the price settled and where your option is. So that's their cash settle. You can trade them. They're European style. And all of this is just to tell you that the VIX is massively important. Actually, the financial news report on this number every day. And it's good for you to know, not only as an indicator, but because you can actually trade it. Now, VIX, we're not going to go into VIX trading because that's a whole different subject. And it's one that deserves a lot more attention than just as a footnote here. But basically, the VIX, the index, has options, and then you also have futures for VIX, and you also have ETFs that you can buy and sell like stocks. So we're not going to go into that. Just know that VIX is very important, and that it's very important for you to understand what VIX is and what it tells you about the market. Now, as a quick summary of what we saw in this lesson, I'm going to go through what we discussed a little bit earlier. So we looked at historical volatility. The definition is how much the stock moved in the past and is calculated from stock prices, not option prices. Realized volatility, almost the same, how much the stock actually moved when compared to the IV for the same period and is obtained from stock prices. IVstrike is the IV from every option, so every type, expiration, and strike, using option prices and applying a pricing model. There are many IVstrikes for every underlying. Okay, every type is call or put, every expiration, all the different expirations, and every strike. So there's many for every underlying. IVexpiration is the IV from every option, so type and strike, call or put, and every strike with the same expiration. It could be referred to as IV month. So it is one IV value per expiration. IVX or IV is the IV from every option for an underlying. At the money and front expirations are given more weight when calculating it. This is the IV that is referred to as an underlying's IV. So this is obtained from every option under a certain underlying, and again the weight is a little bit different for at the money and out of the money, and also for front month and for front expirations and back expirations. So this is very important. This is probably the most important one. This is what we refer to when we mention an underlying's IV, Disney's IV, or the Spiders IV, or Diamond's IV, or the bonds implied volatility. This is the one that we're referring to, not the multitude of options that are under that underlying. It would be very difficult to manage so many values. So the IV is a blend of all of those. IV rank. So these two are relative values. IV rank is a relative measure of where the underlying's IV is today compared to where it has been in a certain look-back period, which is typically 1 year, scaled from 0 to 100. IVR goes from 0 to 100 only, and it's a good relative measure. It tells you whether current IV is too high or too low, 50 being the midpoint, and values that are lower than 50 are going to be, let's say, low values, and values that are higher than 50 are going to be high values. IV percentile is a little bit different. It's a relative measure of where the underlying IV is today, considering how many instances in the past were higher versus how many were lower in a certain look-back period, which is typically 1 year, scaled from 0 to 100. Again, IV percentile, a bit more accurate because it's not susceptible to being skewed because of a single instance of a spike or a spike up or down. So it's if you have it available to you, I would suggest that you use IVP, IV percentile, rather than IVR. But if you only have IVR is much better than nothing, and much better than only using the IV to determine whether you should buy or sell options, or what kind of strategy you want to put on. And finally, the VIX is a widely followed index representing the implied volatility for the S&P 500 index, SPX, over the next 30 days, expressed in annualized form. So it's a short-term indication of volatility, but expressed in an annualized form. So how much it would move for in a year, assuming that the move is taken from the next 30 days. It's widely followed. It's a good single value to look at to determine whether the volatility, or how volatile the market is, and it allows us to track it day by day, and also to trade it if you believe that you have a strategy that takes advantage of this, or if you want to hedge your portfolio. Because remember, high volatility is usually related to the market going down. So as the market goes down, the volatility explodes higher. So that's a good way to trade it or to hedge your existing portfolio. And the way you would do that is there's many products where you can trade the VIX. Where I'm just gonna mention them, but we're gonna have to have a lesson in particular for that, because it's an entire subject unto itself. So VIX, you have the index that you cannot trade, but you have options, and then it settles the cash. You have futures, and you also have ETFs. So that you can trade VIX even though the index itself is not tradable. So I hope this was informational, and that this gives you a better perspective and a better overall view as to all the different types of volatility, what they are, what they measure, which ones are important, which ones are not very important. And now you have the tools to use these numbers and to determine what strategies benefit from this, and also when to put them on and when to take them off. These numbers are used a lot by traders, and especially as you become a better and better trader, you're going to be understanding the nuances and the details of how to trade the market based on volatility, the different underlyings, or volatility itself if you so decide. Thank you very much for your attention, and goodbye.